And hello traders, and welcome to Hybrid Trading FX community. So I wish you guys all a warm welcome. And in this video, we are going to start breaking down this PDF that we made for you guys. So this is going to be a series of couple of videos, and in those couple of videos, I'm going to start breaking down all the things that you have read on the PDF. Also going to break down the trade plan builder PDF, and also I'm gonna break down the Notion template that you have guys downloaded. Just want to introduce you, guide you, how you should use it properly, etc, etc. So this is gonna be a quick course about everything that we basically give you for free. And yeah, that's pretty much it, guys. Again, I just want to mention that I am not going to go in extreme details with this one, because there are certain things that I do not want to tell you. Actually, I'm not going to tell you. It's like, the education that we are providing you on this PDF is just basically something basic about all of the things, smart money, etc. But again, guys, in the hybrid FX trading Discord community that we are teaching proper education. So this is basically 10% of what you guys are going to get if you join hybrid. So I just want to give you a heads up so this. The hybrid strategy is completely different. There are rules in place that we are following. The strategy can be back tested, so you do not need to believe me for my word that the strategy is working, because you can backtest everything for yourself and prove to you that strategy is profitable and the strategy is working. So the strategy has rules in place, for strict rules for entry, so you're never gonna guess, we're gonna execute a trade. We have rules for trade management. So, basically we do not decide where are we going to get out of the trade. Basically, the strategy does that for us. So the strategy is very mechanical and robotized, actually. And it's not allowing a lot of discretion in your trading. And that's really very, very important, because as traders, we tend to have emotions while we're trading. And the hybrid strategy basically eliminates a lot of emotions from our trading, actually. So yeah, guys, basically heads up, this course that I'm gonna basically do now is just a basic knowledge, basic things about everything. Again, we're gonna go through a lot of stuff. Okay, so first of all, we're gonna basically break down the whole PDF. You're gonna gain a lot of knowledge about smart money and price action, in this course. And also I'm gonna give an examples of, what should you be doing as a traders, so it's not all about trading. So I'm gonna give you one example. So treat trading as some kind of sport, some kind of profession. So for example, there are high performance athletes. Let's say, for example, I don't know, UFC champion Khabib Nurmagomedov. Everybody knows it. Everybody knows him. So, guys, Khabib is actually every single day in the gym training. So, like 4 or 5 hours a day, it's his job. He needs to train. He needs to train every single day. And then, when is he performing? When is he winning? It's maybe once or twice a year that he has, a fight coming, and when he goes and he completely dominates, So it's the same, basically the same thing applies in trading. So there are things that you need to focus on, for example, backtesting, forecasting, naked charting, doing your pair characteristics, journaling your trades, doing your ASR, all of these things, that you need to focus on doing daily in order to improve as traders. So you cannot just go ahead and trade, all the time, have like a session, or you're trading like 3-4 hours a day and that's it, you have done your job as a trader. It doesn't function like that. This is the example of why really 95% of people are not profitable traders, because they think that they can just trade on the forex markets and that's basically it. It doesn't work like that. So treat forex as a sport where you're going to consistently improve yourself daily, 1% better each and every single day. So you're going to do those exercises, focus on them so you can improve and be better tomorrow. And again, when you need to perform, when you need to execute, you know that you have the right edge. So we are going to touch bases in this course. I'm going to explain what an ASR is, for example, advanced self-review. Maybe some of you guys know it, maybe you don't. I'm going to explain, I'm going to touch basic on the backtest, journaling, etc., all of these things, but I'm not going to go in a lot of details, okay? So I'm going to just tell you what you need to focus on, what you need to do. But again, guys, if you want a real education, if you want every single little thing broken down for you in the basically smallest pieces, the smallest example possible, you can join Hybrid FX community, because there is really proper education. Okay, so treat this, think of this like something basic that you guys need. It's again going to improve your trading and take you places where you haven't been there, I promise you. But again, it's just the basic knowledge, and advanced things we teach in our Discord, in our real Hybrid Trading FX community Discord. So yeah, that's pretty much it, guys. Again, if you have downloaded this PDF throughout the website, you're gonna see that you have a link here. When you click on the link, it's gonna open the TradingView community. Again, you can join the TradingView community for free, download everything from here. But again, if you want to gain access to this course, you would need to pay for this. So yeah, everybody who is watching this video is already paid. So I hope there was no a lot of confusions about this, but yeah, that's pretty much it. Let's start breaking down and start with this first photo right here. So this is basically example of supply and demand and driving force of the market. So guys, everything is basically supply and demand. Okay, that's really what moves the markets, what drives the markets. That's a supply and demand. So in this example right here, guys, you see how the chart has a lot of details, and with this photo I wanted to showcase what can be done when you are doing your job in your work every single day. So of course, when you start out, when you begin with everything, your charts are not gonna look like this. They're gonna be messy, they're gonna be lines and examples all over the place. But as time goes, as time passes, and you work every single day, your charts are gonna eventually look like this. So this is just a showcasing example of what and how your charts are going to look like once you start doing everything correctly. So let's quickly start from the left and start breaking down this chart. So guys, you're gonna see it here that we had a quite impulsive impulse to the upside. Price had left demand zone, we have imbalance. So what price action tends to do is, when you have imbalance, it tends to fill in that imbalance, and then you have this massive impulse to the upside followed by a couple of retraces. When you see this couple of retraces, this usually indicates that price doesn't have enough momentum to continue to the upside. Okay, so this is actually indicating weakness in form of ascending price action. We're gonna touch bases on that later on in this course, but again, this is indication basically that price doesn't have momentum to continue to the upside. You're gonna see the difference here. Price action is pumping up to the upside, and here price action is just momentum is slowing down. Okay, so there were a lot of traders who would maybe actually wanted to execute here on this demand zone right here, because you're gonna see that this demand zone is actually also very valid. It broke the structure impulsively, it left imbalance behind, it caused a little bit of momentum, but we have a big wick left behind, followed by a little bit of more aggressive retest. So this is why this demand zone actually is not good to trade from, because you do not have a lot of momentum here. Then we had a couple of retraces, guys, and you're gonna see that we had a basically supply to demand flip. Okay, so sorry, demand to supply flip. Demand has failed, supply is in control, and you guys can see we had a little bit of impulse correction, impulse pattern here, entry here, and then this entry was quite actually nice, because you had a couple of other confluences. So first of all, the first confluence that you had is basically direction. This is really important when you're, opening and executing trades. What is this bit of price action telling us is that price action wants to continue downside to fill this imbalance and mitigate this demand zone. Okay, so that's the first confluence that we had, and that's a direction. So once you execute your trades and you have direction in your side, your trades are going to be more higher probability. So for example, you want to target that imbalance, or you want to target that liquidity, because price tends to go where the imbalance or liquidity is. So that's a massive confluence in our favor. Next is basically this ascending price action. This is indication that price doesn't have momentum to continue to the upside. It indicates weakness to us. Then we had a flip as well, and also we can combine a little bit of retail concepts, and you guys can clearly see that this is head and shoulders. Everybody knows about head and shoulders pattern, so that's another extra confluence to take actually shorts here. So a lot of traders would actually buy here. They would look for, this demand zone and they wanted to buy, and they were looking at this demand zone they wanted to buy, but price action was basically indicating that price action wants to go to the downside. Okay, and this, if someone were not maybe interested in trading from this demand, there were traders who were actually looking at this demand right here, and that's again wrong, because price action here is indicating that price wants to go to the downside. And look at this momentum. This is clear example of bearish momentum. This is momentum present in the market. So if you wanted to execute from this demand, it would be considered as high risk trade. Why? Because you were going against momentum, and going against momentum, guys, is never a good idea. We're gonna touch bases on those concepts later on this video. So later on, we saw a little bit of massive price action. When you see, price action breaking the lows and breaking the highs and breaking the lows and breaking the highs all over the place, it usually indicates corrective price action. You do not want to get involved in corrective price action, because, price is messy, not clean, there's no clear direction in the market, etc., etc. So your trades are not going to be high probability. So when you execute your trades in a correction, so basically example is when you catch a trade, you want to win, and when you win, you want to win big. Okay, and basically you want to let your profits run, and when you lose, you want to lose small and cut your losses short. This is basically totally something reversed from a retail trader. From a retail trader's perspective, what the average retail trader is doing is, when he's winning, he's fearful. You're asking yourselves now, why would be a retail trader fearful if he's winning? He would be happy, or whatever. But fear of profits is a major problem for traders. Let's say, for example, you have passed 100K FTM account and you got your hands on 100K capital. That's a big amount of money. Okay, let's say you're risking 1% per trade, and let's say you caught a 10% trade. That 10% trade is gonna run for $10,000. Okay, I don't know right now if whatever you're from, in some countries, that's a lot of money. In some countries, that's, average amounts of money. I don't know where do you come from, but we can actually agree that $10,000 is a lot of money. And when the trade is going for $10,000, you are going to feel fear, believe me. And there's gonna be a feeling where you're gonna constantly check your phone, look at your MetaTrader, look at the trading view, and be obsessed with that position. So you're gonna stress a lot about that trade. And with every single retrace, let's say for example, price is going to the upside. Sorry guys. Price is going to the upside, and then you get a pullback. Oh, when that pullback happens, you are going to be jumping all over the place. If the feeling is not going to be good, because you're going to lose money. Let's say, for example, price was going for $10,000, and all of a sudden we see a pullback, and in that pullback you lost $4,000. You're gonna feel, you're gonna instantly feel fear that you're gonna lose that money, and believe me, you're gonna scare close the position. And maybe that's against your risk management rules, trade management rules, but you're gonna scare close it. So this is why we feel pressure. When we're winning, and this is why as traders we are mentally fearful when we're winning, and we're hopeful when we're losing. What I mean by that, price is going in your stop loss, and then you're praying to Forex gods. You know that feeling? Please reverse and magically go in my take profit. But reality is it's not gonna happen. Okay, so this is why retail traders tend to play with their stop loss. So let's say for example their stop loss is here, they're gonna move it. And let's say they risk 1% per trade, and all of a sudden they're gonna lose 1.5, 2%, 3%. Believe me, that happens. If you have done it, please never do it again. That's the basic mistake that people are doing. So again, when they're winning, they're fearful, and when they're losing, they're hopeful. Again, guys, you want to basically reverse that. So when you win, you want to win big and let your profits run. And when you lose, you want to lose small and cut losses short. Okay, so this is why trading in correction is never a good idea, because you cannot have those high risk reward trades, and thus you cannot win big when you're winning. So again, guys, here we saw a little bit of corrective price action. Then we had this impulse correction, impulse pattern, beautiful example of momentum in the market, beautiful continuation. We could execute our trade here on this demand. We had a push up, we broke the structure, but we have a big wick behind. We saw that we had a little bit of pause here in momentum because we had impulse correction, impulse. This supply zone, this was basically a reaction from this supply. Okay, price reacted a little bit, consolidated for a little bit, and then pushed the price up again. This was also indicating a little bit of weakness. Again, we're breaking the structure, retracing, breaking the structure, leaving the wick behind, retracing, again breaking the structure, retracing, and coming back aggressively again, going against momentum with volatility. Our stop loss was here. I'm not gonna reveal a lot about stop losses, entries, exits, etc., because if you want to learn that, you would need to join Hybrid Trading FX community. So again, guys, we had impulse correction, impulse. Again, the same thing. This was corrective market, and then here we had a quite nice impulse. So this trade, I do not need to talk a lot about it. I mean, you see that it's really, really beautiful. We are putting in new low lows in the market. Prices, showing us this descending structure. We're basically, going with the trend, following the money. We had this impulse correction, impulse pattern, big wick left behind. We had this volatility. So to enter here on this first entry, as you can see, price barely missed us, and it would not be a good entry because price is coming back on volatility. I'm not gonna talk about volatility a lot and what volatility is and etc. Again, price retraced, again pushed above a little bit. We saw that we had a liquidity forming in this double top. Price reacted, swapped that liquidity, and boom, a perfect, really beautiful trade. So this price action is on AUD USD. I do not remember the exact date and time when this happened, but this was example of 1 hour time frame. So I think this happened in 2022, if I remember correctly. So you can go ahead and watch this live example on the charts as well. So that's basically it, guys. I want to break down the trades. I want to break down the price action and show you how I read price action, what I'm looking for. Maybe right now, when you're looking at it, you do not understand nothing. Maybe it's a little bit complicated, but again, practice makes perfect, guys. Show up every day, do some work, spend time on the charts, and believe me, your charts are going to look like this when you have a lot of details. You know what price action is doing. I always tell my students, price action is basically the language of the market. This is how price action basically is speaking to us. Okay, so at the beginning, once you start, it's hard to learn it. It's like learning foreign language. It requires a little bit of time. You cannot go and attend, 10 classes, foreign language, and you can have a full conversation with someone. You cannot do that. You need practice. Again, practice makes perfect. So just show up every single day, do some work, and believe me, in time, your charts are going to be looking like this. Okay, so let's move on to another example where I'm going to speak about order blocks. So how to spot order block and what are order blocks basically. So guys, again, this is the reversal type of entry, and we have here two examples. So we have example of first reversal. So we have impulse to the upside, retrace, again impulse to the upside, and this bit of candle broke this last low, made change of character, and this is considered as a reversal trade. So our order block is always the last candle before momentum. So we see the momentum here. So we mark this low and this high as an order block. Okay. This example here, right here, again, we're marking this here. So more about refining the order blocks and how you can actually manage those things. What is the best, entry? What type, when you see different kind of price action, you're maybe wondering where should I get involved, what is the best entry. Again, you would need to join the community for those things, guys. Again, you can read all of those things that I wrote here, and basically this is going to explain everything about a photo. But basically, order block is the candle before the momentum happened. Okay, so we're gonna touch bases about order blocks and what is high probability order block, what should you consider, trading, we're not trading, etc., in next couple of examples. So again, this is a chart example of basically this, a reversal, price going to the upside. Again, when you're looking at the price and when you're looking at the reversal trade, catching a reversal trade is gonna be a little bit more tricky. So again, if you plan on trading reversals, they can be a little bit tricky because you never know when that trend trade is going to occur. So for example, trading continuations for me personally is far more better, easier, because you're looking for momentum and basically you're following the trend. And when you want to catch a reversal, basically you're guessing where that trend is going to end. So it's a little bit more trickier to catch a reversal than a continuation. But at the same time, if you catch the reversal, basically when it happens, you can have a really big risk reward trades. So, and you're going to have maybe a little bit more losses, but you're definitely going to compensate that with a really high risk reward trades. So again, if you're a beginner, I would maybe stick more to the continuation because they are easier than catching a reversal. But again, it's up to you and whatever you want to do. So I'm going to give you a couple of tips. What should you look at when you're, looking at a reversal? So first of all, you want to see ascending price action. So you do not want to catch a reversal when there is a momentum in market to the upside. So in this example, we can clearly see that we are breaking these highs, retracing, breaking highs, retracing, breaking highs, retracing, breaking highs, retracing. We are breaking highs and retracing, and this is indicating to us that there is no momentum in the market to the upside. Also, we are forming this liquidity. So you're going to see that we have tons of trend line liquidity below this. Okay, and then when you combine those things, momentum is not present to the upside, and we have a liquidity below. When you have this, boom, nice momentum to the downside, making this change of character, This is considered as a high probability order block, high probability zone where you can take your trades from. So again, you see impulsive break of structure, okay? Impulsive break of structure. We impulsively broke. We didn't broke barely, okay, this last low. And then also we had a strong candle close. So we didn't had a big wick left behind. Big wick left behind usually indicates weakness. When we break the low with weakness, that usually indicates weakness. We had a momentum here. We had quite nice 2 candles. So we had a strong close. So this is why this is considered as a high probability reversal trade. Again, watch out, guys. Sorry. Watch out, guys, when you're trading them, because they can get a little bit tricky. Also, quick tip. Let's say it's, again, pair characteristics are really, really important. So getting to know the pair that you trade. So I'm going to give you an example. You cannot trade a strategy and trade that strategy on all the pairs that exists. Okay, whoever told you that is basically lying to you. There are a lot of smart money traders. Sorry guys, something is in my throat. So there are a lot of traders who are telling you here there are smart money concepts, trade them basically on all the pairs. Maybe that works for someone. For me, I do not like to do that. I like to get to know the pair that I'm trading. So this is why in our community we do pair characteristics, where we basically take the pair and we start breaking down all the things that are happening on it. So some pairs, for example, love reversals more than continuations. Some pairs love continuations more than reversals. And this is the information that you're going to get when you start doing pair characteristics. So for example, like the price action as a whole is the language of the market. Every pair has its own language. So for example, Euro USD is, English language. GBP USD is German language. AUD USD is French, etc., etc. So, you cannot take the strategy and apply it to all of the pairs. It doesn't work like that. Maybe for, some smart money traders it does. I do not trade pure smart money concepts. I trade my own system that we have invented called hybrid trading. It's a combination of smart money and pure price action. So we are getting, in those things, and we are all breaking down the pairs and, basically looking at their nature and really looking at what is going well on them, what is not going well on them. So for example, JPY pairs do not like reversals. JPY pairs tend to go in this longer ascending price action, and they tend to give us a lot of fake outs. But those fake outs, those break of structure, are usually sweeps. Okay, so usually they're traps. So what's gonna happen if this is on JPY pair? If this happened on JPY pair, you're gonna have this impulse to downside, and then all of a sudden you're gonna have breakout traders who are gonna sell. Breakout traders are gonna immediately sell when they see this strong close. And then you're gonna have breakout retest traders that are most likely going to execute here on this low. Okay, they're gonna have their entry pending order here, and then you have smart money traders who are executing on this order block. Price action is gonna completely swipe them all out and continue in this ascending, and then it's gonna happen again. You're gonna have a reversal trade, it's gonna sweep them. Reversal trade is gonna sweep them. So JPY pairs in general tend to do this a lot. So here you go, a quick tip that you can actually go ahead and backtest. Again, guys, I would love if everything that we are learning here in this course, I would like you to go ahead and apply it on charts. Backtest yourself and see all those things, because again, this is how you're going to improve. This is how you're going to learn things. This is how you're going to advance. Okay, this is how you're going to get to know the things and concepts that we're speaking about in these videos. So when you're finished with the video, go ahead and apply it to charts, go ahead and backtest it, go ahead and see, everything that we're talking about. So go ahead and check out the JPY pairs. You're gonna see that there's a lot of fake outs, and there's a way that you can take advantage of that, and there's a way, so yeah. Let's start breaking down the second thing. So again, guys, here is another example, or reversal trade. Again, you have liquidity, you have weakness to the upside. Again, it's a reversal setup, price breaking above. You see how we're breaking the highs barely. We do not have momentum. Then also, boom, we have this quite nice impulsive breakout, change of character, and this is higher probability order block again. I showcase this example because here you see that the last candle of the momentum, we mark it here, and here we mark this candle. So here we mark the candle on the left, and here we mark the candle on the right. So it's a small refinement of the order block, because you do not want to get involved here and set your stop loss here. Why? Because if you're looking at the candle on the left, why? Because here you're gonna have a worst trade. Your trade is gonna have more pips in it, so that means when you win, it's gonna be less profits. So you're refining your order block, and this means that you're gonna have less stop loss, less pips in your stop loss. You're gonna open up a little bit more lot size in it, and if you win, you're actually going to win bigger. So yeah, focus on the last candle that caused momentum, basically. So that's pretty much it. Let's move on. This is example of continuation entry, plus how to refine our block again. So again, guys, this was a reversal type of entry. We were showcasing a reversal type of entry, and here we're gonna speak about continuations. Okay, so when you're looking at the continuation, guys, you want to see a clear momentum. You want to see impulse, you want to see correction, and you want to see impulse again. This is basically how market moves: impulse, correction, impulse, correction, impulse, correction. Okay, so again, there is a difference between good continuation and bad continuation, and we're gonna, of course, explain everything here. So again, guys, what is important here is to look at how the price is breaking the highs. So if the price is breaking these highs impulsively, this is considered a good order block. If price action has left imbalance behind, this is also considered as a good order block. Again, if price action has broken this high with a couple of candles, 2, 3, 4 candles, this actually means that it's most likely the price action is going to continue to the upside. If price action breaks only with one candle, it's a little bit less high probability. So there are things that you are going to look at, when you're considering trading continuation trades. So you want to see, again, impulse, correction, and impulse. So there are certain things, certain cases when you're going to have ascending price action and you're going to have an impulse, and you're going to only have one impulse, and price is going to come back to that order block. In those cases, that's not clear continuation. If I were you, I would stick to this. So you are looking at impulse, correction, impulse, not just one impulsive leg to the upside. Okay, there are certain pairs that you can actually trade those kind of setups when you have ascending price action, only one impulse. But in a majority of the pairs, those kind of continuations are not that great, not that good. Okay, but there are certain pairs that love that kind of price action. They respect it really, really good. Okay, so again, guys, do your pair characteristic, do your due diligence, do some work, and yeah, there are certain pairs that you can trade those type of setups for the continuation trades. But if I were you and I were just starting out and I do not know anything about those things, I would stick to continuations like this. So you're always looking at a first bullish leg that is impulsive, then you're looking at the pullback. You want to see corrective pullback, slowing down in momentum, and then you want to see another impulsive leg to the upside. It's broken these highs, has multiple candles that are breaking, has left imbalance behind, and you see a classic impulse correction, impulse pattern. This is high probability. Okay, so this is again example of how that is going to look like when you're trading. When you look in the charts. So you guys, again guys, you see this impulse, massive impulse to the upside. This is a retrace. This is called a retrace, and then price action breaking above again impulsively. You see 1, 2, 3 candle. Look at this bullish momentum, beautiful. We broke the high impulsively, so this is why this is considered high probability order block. Also, what you want to see here is corrective pullback, but we are going to talk about those things in later. Okay, so continuation entry chart example 2. So again, another chart example of a continuation entry, guys. Impulse to the upside, massive impulse to the upside, retrace, and then again massive impulse to the upside. So again, there is an imbalance left behind here and here, guys, and you have this unmitigated order block right here. So there were a lot of traders that actually prefer to trade from this extreme zone right here. So I would tell you this right now: there are certain cases when you want to execute from extreme, and there are certain things, cases when you want to execute from this order block as well. So do not be fixed with, okay, I'm gonna only execute on extreme because that's safer. It's not really. What is important is that you read the price action, okay? And basically charts, candles are gonna tell you everything. If candles are indicating to you that there is a momentum in the market, you have impulse, correction, impulse pattern, and you have this momentum here, you have this, look at this, price is breaking the highs impulsively, price is leaving imbalance behind, prices, we had a quite good close, not that strong close, but you know, pretty okay. If you have a corrective pullback right now, if price action is correctively coming back to your order block, this is again indicating that price is correctively coming back. It doesn't have momentum. So if you have aggressive pullback, it would be better to execute from extreme, because you know you do not want to go against momentum. Price action is indicating, you know, momentum to the downside. It's most likely going to fill this imbalance. But for example, if you have a corrective pullback coming back to the order block, what is that indicating to you? Price action doesn't have momentum to continue to downside, and also what price action is doing as well, it's generating liquidity on the way down. So sometimes you want to execute from extreme, and sometimes you want to execute from this order block as well. So there are times when you're gonna, you know, execute here, and there are times when you're gonna execute here. This is bringing a little bit of, you know, a little bit of, it's gonna be a little bit of tricky for you, because you know you do not have a clear defined rules in place that you're gonna follow. And then, you know, it's gonna be you looking at the charts and where should I execute from? Should I execute from here, or should I execute from here? And this is why it's always better to have strict rules in place. You know, you're gonna write down the checklist. First, you're gonna, of course, backtest everything. Then you're gonna write down the trade plan. Then you're gonna write down the checklist. And then when you see certain things happening in the charts, you're gonna check your checklist, okay? And then you're gonna see, okay, if I see this, I'm executing from the first order block, I want to take advantage of momentum, checked. If this happens, this, it's better for me to execute from extreme. But do not be the guy who is gonna just listen to people and they're gonna tell you it's always better to execute from extreme, and you're gonna just follow that. That's really not that good. You don't want to be a sheep, you know, and just listen to what other people are saying. Go and backtest things for yourself. Test them out, see what's working for you, what's not working on this pair, on that pair, this strategy, that strategy. So you need to test things out, you know. So again, we have in hybrid FX community, we have clear rules in place for execution, so we do not have those problems with discretion. You know, it can be a little bit tricky because you are trading with emotions, you know, a lot of times. And then, you know, it's going to be, do I trade here from here and here? And maybe price action comes aggressively, but you liked other price action. Then you know, take a trade here, and then it's finished in stop losses. And then you get angry, then you execute here. You know, that's not allowed. That's not trading. That's not good trading. That's trading purely based on emotion. And that can happen when your strategy is discretional. So this is why it's always better to have predefined rules in place for every single thing. So, you know, those emotions cannot occur, and you have basically strict rules in place that you're going to follow. It's really easier because, you know, you're trading like a robot, basically. So Yeah, always do a checklist, guys. Especially if you're a beginner, checklist is very, very, very important. I remember myself when I was starting out with trading, I had my checklist right in front on my PC where I'm trading, so it was right there that I could see it. And yeah, so yeah, I had it. I remember those things. I do not have it anymore. Everything is my head. But yeah, if you're starting out, having a checklist is really, really important. It's gonna help you tremendously with your emotions, guys. Okay, let's move on to the next example, guys, and you're gonna see here that we have a confirmation entry model. So we showcased it here, continuation reversal and continuation reversal that are a little bit more risky. Okay, so this what you have breaking down right now, continuation. Okay, first example was continuation, and second example was a reversal trade. Those type of trades are considered a little bit more aggressive. Why? Because I told you, okay, there are gonna be trades on JPY pairs, and you're gonna have inputs to the upside, you're gonna have change of character, and you're gonna have certain things, and it's gonna be boom, fake out, price is typing you out, and then you're like, what happened here? And you're gonna have a continuation also as well, and price boom tags you out. For example, fills this imbalance right here, and continues to downside. It can happen because this is more of a risky entry. And here we're gonna talk about confirmation entry. So in this case on the left, in this example on the left, we have a reversal entry type, and here we have a continuation entry type. So what is the difference between the first reversal and confirmation entry reversal? Difference is that we are not going to execute on this first change of character. Okay, so this first change of character can be a fake out, so price can easily continue to the upside from this point on. But in this case, we want to be a little bit more safe, and we want to execute our trades from our better zone, from confirmation entry. Then you're going to wait for reaction. This is called a reaction, this order block. So it's not going to be used as execution. It's going to be used as a reaction. If you see reaction from that order block and price starts to break this low again impulsively with momentum, there is on this newly refined order block you want to take your trades from. This is considered as more high probability entry. Okay, why? Because right now you're not guessing. You're not guessing if you are going to catch that reversal. Is it going to be a fake out or not? Because price is already confirming to you that it's reacting from this order block, and you have nice reaction. Again, price is right now confirming the structure. Okay, it's not just breaking lows one time and that's it. It's breaking the lows and again confirming that we are breaking the lows. Again, you're looking at how do we break the low. If we break the low impulsively, that's again another good confluence. If you have a strong close, that's another good confluence. If you have imbalance left behind, this is another good confluence. If we have a corrective pullback, that's another great confluence. We had a reaction, that's another great confluence, and we had this ascending price action as a weakness to the upside. So again, high probability confirmation pattern. Okay, again, it's a little bit safer entry, because you're not guessing. Price is confirming to you that it's showing you reaction, showing you break of structure. Technically, this is not a reversal trade because it's a continuation, because first change of character is actually reversal, and then when price retraces and breaks again, it's called continuation. But again, it's coming from a reversal trade, so technically it's a continuation in a reversal. So if that makes any sense. But again, it's a little bit more safer to trade from this type of entries, than the ones we showcased in the last lesson. Again, a continuation entry model, guys, if you want to trade good setups, this is the price action you want to focus on. These two bad boys right here, especially this one, because I told you trading continuations with the trend is far more easier. So again, price, what is price action indicating here? Impulse, retrace, impulse. And again, we are not executing from this order block. We're looking at it as a reactional order block. Price again moving to the downside, reacting from it, and again moving massively with massive momentum to the upside, breaking this high, leaving imbalance behind, and we have a strong close. This is indication that the trend is there, trend is present, momentum is in the market, and this is where you want to take advantage of that market. This is where your trades are going to be far more high probability if you enter on those type of setups. Okay, so again guys, really high probability examples of, again, confirmation entry model. So again, I'm telling you to go ahead and test things out. Okay, go ahead and backtest this, go ahead and look it on your charts, and you're gonna see that these two type of entries are actually pretty good. So this is again chart example, guys. So you're gonna see that we have this ascending price action to the upside. Again, we have liquidity, we have weakness to the upside. We're breaking these highs, retracing, breaking these highs, leaving a week behind, retracing, and then boom, this impulsive breakout to the downside. How do we break this low, guys? Impulsively. Do we have imbalance here? We have. Do we have momentum? We have it. And then we are looking at this third block as a reaction or block. And then price comes back to it, reacts to it, and then boom, breaks this low again one more time. So this is considered as high probability or block and confirmation model. Okay, confirmation entry type. Again, another example of a continuation, guys. You have this massive impulse, momentum is present, retrace, momentum again, touch the block. We had a lot of liquidity right here. The price action wants to sweep. We had a reaction, as you guys can see. Boom, we broke again impulsively, and then we had a quite nice bullish move to the upside. This is where you want to get involved on those confirmation entries. Okay, so, and again, another example, guys, of master the language of the market. This is just example of how those trades should look like when you're about to execute them. This is really good example of the trade that I was in on Euro USD. I think it was also 2022. Really beautiful trade. And if you think that I was stopped out, I was not. You can even go ahead and watch the story highlights on hybrid. I actually forecast this trade in advance, and later, when I caught this profit, I recorded the profits live. So you can see that I was actually live in this trade and even posted it before I took it on Instagram and after. So you maybe thought that this was a stop loss. A lot of people, when I shared this trade, they're telling me, yeah, but you got stopped out. I didn't. Okay, I didn't. Spread didn't caught me, and I was still in this trade. Okay, so let's break down the price action, and it was really good and beautiful example of how you should trade continuations and how you should trade with confluence, multiple confluence, trade with the trend and whatnot. So again, we had this, you do not see the whole chart, but this was descending price action. So again, indicating weakness to the upside, that price is tired to continue to downside. We had this impulsive move to the upside. We broke this this high right here. So we had this change of character. So we reacted. We are using this order block as a reaction, not for entry, because it's really risky to consider this as an entry. And again, we broke again above. We didn't had a quite impulsive breakout. So again, to trade from this, it's actually really quite aggressive, quite risky. And again, we had another impulse to the upside. We had an impulse correction impulse. Again, price started to arrange a little bit, and then we broke again. And then we had a trade right here. Again, it was a little bit more aggressive, So again, we are using it for a reaction. So this was again another reaction, and right now price is again breaking to the upside, So what we're seeing so far here is that price was going in descending price action, okay, indicating weakness to the downside. We had a basically shift in momentum. We had a reaction. We had a second reaction. We had an impulse. We had a third reaction, and we have this momentum. So we have confirmed that price action is putting higher highs in the market, that the structure is bullish. Order flow is also bullish, Okay, we are seeing in this chart that price wants to trend to the upside, and this is where you want to get involved in a market. So you're gonna see, guys, that we had only one bullish leg here. You know, this is what I was speaking about in the previous lesson, when I told you that it's always better to execute continuation trades when you have impulse, correction, impulse. But there are certain pairs, some pairs, that you can actually execute from only one leg, and it's high probability. One of those pairs is Euro USD. This was on Euro USD. This was also 1 hour time frame. I caught this on 1 hour time frame. Execution was on 1 time frame. Trade management was on 1 time frame. Everything was on one hour time frame. I was not going lower to execute this. Okay, so we have seen, again, we're breaking the highs, we're putting new highs, higher highs in the market, we're having multiple reactions, and we have this impulse, beautiful momentum. We had a retrace, and again, we had, two types of liquidity here, guys. First, we had this descending price action. As you guys can see, we're breaking the highs, retracing. Breaking the lows, retracing. Breaking the lows, retracing. Breaking the lows, retracing. Breaking the lows. We're breaking the lows and retracing multiple times. So we do not have momentum to the downside as we had here to the upside. So this is, again, indication price is tired to continue to the upside, to downside. And again, guys, you can treat this as an impulse, correction, impulse. You know, market moves like that. When you have impulse, you have correction, you have impulse, price is most likely going to do this as well. Impulse, correction, impulse, correction, impulse, correction. So this is a beautiful example of it. Okay, so we have two types of liquidity as well. So first, price is tired to continue the downside. It's making liquidity here. So you have this trend line liquidity right above this descending price action. And then also we had this double bottom liquidity. Okay, so this is called inducement, guys, and this makes your order block more higher probability. And as you guys can see, price started the order block, barely missed stopping you out, and then continued to the upside. There are a lot of trades that this can happen, where you're gonna have basically that you have a little bit, you know, price barely didn't touch your stop loss and continued massive profit. We had a trade on AJ on February that brought us massive percentages, massive percentages. I earned more than $15,000 on that trade. It was really good trade, and it also was the same thing. I was sleeping when I managed the trade, so I took the trades during the day, and it was a day trade. So I'm again letting my profits run. So I'm leaving it open while I'm sleeping, and I'm waking up to check it. And I woke up and I saw that price barely touched my stop loss, but it didn't. And while I was sleeping, I thought, okay, it's gonna finish in stop loss. That's for sure. What I'm looking at is now, it's gonna be a stop loss. And basically, I left my phone. I go back to sleep, and I wake up, and it's in massive profit. And I'm like, whoa. So those things actually can happen, but again, never be hopeful when you have those type of scenarios, and never ever move your stop loss. Never do that. That's a really big no-no in trading, guys. Never do that. If you have a stop loss there, that's it. Leave it like that. Sometimes it's gonna happen. Price is gonna basically tag you out for a little bit, and it's gonna continue up. It's the part of the game. You cannot do those things. Again, I'm telling my students always, focus on things you can control and ignore those you cannot. What you can control is your execution and your trade management. What happens after you're in the trade? You cannot control those things, so why stress about them? If price action wants to tag you out or miss your entry or go in profit, whatever, you cannot control those things. That's basically market. What market decides it wants to do, market is going to do. You cannot control those things, so do not think about it. Do not stress about it. Okay? Focus on things you can control. And again, that's your entry and exit. That's it. So really high probability trade, guys. As you guys can see, again, multiple reactions, order flow is bullish, putting higher highs, trading with the trend, impulse to the upside, inducement, weakness to downside. Perfect example. Boom, massive impulse to the upside. Again, how do we manage trade. I'm not gonna explain that because again, you would need to join the hybrid community to know why I executed here. Again, there are rules in place that we're following. So if certain price action happened here, I would not get involved in trade. I'm not gonna expose those rules. It would not be fair for other community members. So I'm not gonna do that. I'm also not gonna talk about why I exited here. So we had a weakness to the upside again, guys. We were breaking. VBOS means weak boss. So this is weak boss. Okay. So we see weak boss here, guys. We were breaking the highs and retracing, breaking the highs, retracing. This is again what? Ascending price action. What is ascending price action indicating to us? Weakness to the upside. So what we want to do, we don't want to hold this trade for I don't know how long, because why? Price action is indicating weakness. This is momentum and this is weakness. This is not a pullback. If we had a pullback like this, of course I would like to get involved, even maybe in a scaling, because I want to take advantage of that trend. If I saw another impulse and if I saw another pullback, this is going to indicate to me that price is most likely going to continue the trend. And if this happens, if we see ascending price action and weakness, this usually indicate to me that there is no momentum in the market to the upside and price is tired to go to the upside. It's most likely going to show me a reversal and you're most likely going to fill in this imbalance. So this is why we're getting out of the trade here. And again, we have strict rules in place that we're going to follow. We just do not, make it blindly or set it like we want it to. It's all with strategy. How strategy dictates, we follow. So yeah, let's move on, guys. And this is going to be example of high probability continuation entry model. So again, pretty much the same thing that we talked about in a previous lesson, but a little bit more in details what you want to see here. So first, you want to see momentum. When you're looking at high probability continuation, you want to see impulse, correction, impulse. You want to see momentum in that market. So first, you're going to focus on this. First, bullish leg has to have momentum. Then you want to see corrective retrace, corrective pullback. And then second leg also needs to have momentum. Momentum is really important, guys. If you're trading with momentum, your trades are going to be more high probability. If you're trading against momentum, you're going to lose a lot. So then momentum is here. We see this. What we want to see next is strong break of structure. We have high probability break of structure here. How is this price action breaking the previous high? Pretty impulsively. We have momentum in this market and we're breaking the structure impulsively. Then the third thing that we want to look at when you're looking at high probability continuation trades is strong candle close. So this is a strong candle close. We see strong candle close here. We do not see weakness. So we may be left a week, or maybe we have a couple of retraces and again ascending price action, etc., etc. So we have momentum in this close right here. So again, another indication that price action is most likely going to continue to the upside. Then we want to see a corrective pullback, guys. Really important. So if you see a corrective pullback, this is again indicating to you that price doesn't have momentum to continue to the upside. Also, it is generating liquidity on the way down for the price to push up and take that liquidity. Okay, so corrective pullback is really important. If you have aggressive retest, aggressive pullback coming to that zone, it's not going to be that high probability. Why? Because you're going against momentum. If momentum starts to go bearish and you have a stop loss, and if your stop loss is tight stop loss, price can easily tag you out of the position. So it's better to go with momentum than against it. Again, extra confluence, you can add extra confluence as for example, imbalance or liquidity. So if you have some imbalance or liquidity above, this is going to be another extra confluence in your direction that you want to take your trades from, because you want to target that imbalance in liquidity. So sometimes you're going to have liquidity imbalance against you. Sometimes you're going to have, for example, you're going to have liquidity here, you have imbalance here. And then you're going to be like, do I want to execute from this or block or not? This is why I do not like to have those type of questions coming to my mind when I trade. And this is why I have strict rules in place that I'm following, and I know exactly when I want to get involved and when I do not want to get involved. Again, guys, when the momentum is present and market is showing you that it's breaking the structure and retracing, with momentum, and you see clearly the price doesn't care about, taking that liquidity or taking that imbalance, it's just continuing higher. You want to execute your trades. You want to follow that trend. You want to take advantage of that momentum. I see a lot of traders that are falling in love looking at imbalance and liquidity, and imbalance and liquidity is everything for them, but they do not understand that imbalance and liquidity doesn't need to get filled right away. Okay, so imbalance acts like a gap. Okay, basically the price action tends to fill in the gap. Price action also tends to fill in the balance, but it doesn't mean that it needs to fill it right away. Sometimes days, weeks can pass before that imbalance or liquidity gets taken. So if the most recent momentum is bullish and you're seeing the impulsive break of structure and you're seeing the trend is present and you see negative confluence imbalance of liquidity and you do not want to execute that trade, that's not good. Okay, you want to take advantage of momentum. You want to take advantage of that bullish roll form. You want to take advantage of that trend. If you see prices breaking highs, breaking high, retracing, then okay, you have imbalanced liquidity below, it's not good. But if you see the price action is breaking impulsively and it doesn't care about filling that imbalanced liquidity, your trades are gonna still be high probability no matter the imbalanced liquidity. Okay, guys, you need to understand those things. I know that a lot of people are teaching you that imbalanced liquidity is everything, but it doesn't need to get filled right away. Sometimes weeks can pass before that gets filled. Okay, so again, this is another example, guys, of high probability continuation entry model. So you have impulse, correction. Okay, this is really important, and again another impulse. Really beautiful example. Again, guys, you're seeing everything, and then you have momentum, you have correction, you have imbalance as well here. So this is exactly my point, what I was talking about. If you have right now corrective pullback, this is a perfect example of executing trade from this order block. And I know that a lot of people have taught you that no, never do this, always trade from this extreme because it's safer. In a lot of cases, price is not going to touch the extreme. Why? Because momentum is present. We're breaking the highs impulsively. Price is indicating to you that it wants to trend to the upside. Okay, and then you're gonna miss on a lot of opportunities because you're looking at the extreme. And if price action breaks below, and let's say tags us out from this trade, it's most likely it's gonna tag us out from this trade as well if momentum is against you. So in this example, if again price action comes with momentum against you, if price action is bearish, showing us bearish momentum, we're not gonna execute from this order block. You can start looking for this order block, okay, or this order block right here. I don't know what is your strategy and how you do trade. Again, in hybrid, we have strict rules in place. For us, this would not be valid. Okay, so again, I don't know what you're trading. Maybe smart money, maybe some other strategies. But again, it's basically you making a decision at the end of the day. So if the aggressive, if you see aggressive pullback, it would be safer to execute from extreme. And if you see a corrective pullback, this would be classic taking advantage of the momentum. So here, guys, we're talking about corrective pullback. Again, pause the video and read everything. I have provided you with a lot of information about what I was writing here. So it would be better to first read and study the PDF and then watch the videos, because you're already going to have a little bit of knowledge about and understanding about the PDF. And then, when you watch the videos, everything is going to be explained a little bit more detailed. So it would be better for you to, read everything, study it, and then watch videos. Okay. So again, guys, classic example of continuation pattern. We talked about this. We had impulse, we had correction, we had impulse. Okay. We had impulsive break of structure. We had imbalance left behind. We have all things are ticking basically in this order block. And then whether you have a strong candle close and then you have a corrective pullback. Look at this, beautiful. We have liquidity above, we have weakness to the downside. this is higher probability or block. So when you're taking your trades, you want to see this kind of price action. This is going to help you tremendously when you're trading on your charts. Just look at this pattern, study it, go find it on the charts, and believe me, your trades are going to be far more high probability if you're using all of these concepts. Okay, so again, guys, we're not basically in this videos, in this course, we're not I'm not basically learning you strategy. I'm not showing you the strategy. I'm teaching you certain concepts about price action. And again, guys, I told you price action is the language of the market. So let me give you an example. Chart, basically candle, is there for the first time ever. From the beginning of the existence, candles are there. And until the end of the existence, the candles are going to be there. So when you learn to read price action and to read actually candles, you're going to be able to trade for a longer period of time. No one is going to take that from you, that knowledge from you, when you learn to read candles. So market is consistently changing. You need to understand that. Okay, in market we have phases. We have a corrective phase, we have a trending phase, we have a momentum phase, we have all of those kinds of phases that are happening in the market. So 1 month you're going to see price action is corrective. The second month price action is going to show you trends. Your job as a trader is to recognize those things and adjust your trading accordingly. So when the market is corrective, you want to recognize that, you want to adjust your trading, and you want to be a little bit more protective of your capital. You want to focus on protecting your capital. Okay, and when the market is trending, you want to again recognize that, spot that, and adjust your trading accordingly. Switch because you want to take advantage of that trending market. That's your job as a trader. But again, I want to explain to you that market is consistently changing over the time. Okay, so if you have a strategy that is actually working right now, go back test it 10 years before and see if that strategy was working. Okay, it's a little bit complicated. Maybe the things that you know now, the strategy that you're working with now is profitable and it's working, but it doesn't mean that it's gonna work in 5 years time from now, 10 years time from now. Why? Because market is consistently changing. You can see that 2019 was really great year, a good year. And then we had 2022 and there was a corona. Volatility all over the place. The period of the market was pretty bad. Then 2022 was also pretty good year. And then 2022, again, we had the Ukrainian war, we had recession, we had, collapses all over the places, financial, everything happened in 2022 as well. It was also a little bit of, not that great of the year for price action. So market is consistently changing, and over the longer period of time, again, market is going to change. So maybe the concepts that you're using now that are working for you are not going to work in 5 years time. You need to think about those things. But if you learn to read the candles, and if you learn to read the price action, the language of the market, you're always going to adjust those things. So if you see, you're not going to change your trade plan. You're not going to change the strategy. But your job as a trader is to work every single day on improving yourself and improving your trade plan. So maybe you're going to see that certain things that were working do not work that good now. Maybe I'm going to change this. Of course, you need stats. You need numbers. You cannot just change things. You need to backtest things. You need to have the data. You need to test the data. You need to, do your ASR, trade plan, backtest again with that created trade plan. There's a lot of work. You cannot just do things, But again, I'm telling you, price action is going to change. Market is going to change. And if you learn to read the candles, no one is going to take that away from you. So you can always adjust your trade plan. Adjust your strategy. Maybe there are going to be new patterns in 2023 that we didn't saw in this couple of past years. Maybe there are going to be new patterns. Why wouldn't you want to recognize those patterns and take advantage of them? You understand what I want to say? So this is why those concepts that I'm gonna teach you right now are gonna basically last, okay? And with this knowledge, you're gonna gain knowledge of the price action, and you're never gonna be left behind. You're not gonna be like, okay, I trade this strategy, I trade these concepts, and I believe in them, and then in 5 years, boom, the concepts are not working anymore. This cannot happen with price action, because price action is everything. So once you start to learn the price action language of the market, you're gonna be good for life, okay? So again, guys, a really high probability example of a continuation trade. I really advise you to go ahead and backtest this. Check it out on charts. Send the charts in the community, guys. We're gonna check them, give you enough feedback, so it's actually not a strategy, but it's actually this course is going to improve your knowledge about the price action, so you can combine the strategy that you have with all of those concepts, that I'm teaching you, so your trades are going to be higher probability and everything. Okay, let's move on. And this is basically a corrective pullback chart example, guys. Again, you have a reversal here, price action slowing down with momentum to the downside, no momentum to the downside, as you guys can see. And then we had this break of structure to the upside. You see strong momentum here. This was quite aggressive, a little bit more aggressive a pullback, but if you use this as a reaction, it would be fine. We didn't had cause of momentum, guys, here. We didn't had a momentum right here. Also, when you're looking at order blocks, guys, a lot of people would actually mark maybe this as an order block. But if when you're looking at a high probability order block, again, focus on a couple of things that we mentioned in the previous lesson. First, you want to see momentum. There is no momentum. What caused momentum here? There is no momentum. There is weakness. There's not bullish momentum like here. So this is not considered as high probability, even though we had a reaction. You do not have momentum. Second thing that you want to see is impulsive break of structure. What price action did here? Did nothing. Didn't break the high up until here. Okay, and then second, again, you want to combine it with imbalance, etc., etc. So we have all those things. We talked about them. Go to previous lessons and you can check them out. So again, guys, here we have impulse correction, impulse price coming back slowly to this order block, making this a little bit of liquidity, coming back again, making liquidity to the upside again as well. We have this order block right here, price boom, reacted really nicely, and then you see this momentum. Look at this bullish momentum here. This is beautiful. Again, chart indicating to you reversal, reaction, moving to the upside, a little bit more of corrective market right here, but again, pretty good momentum. And then you had reaction, impulse, correction, impulse, correction, impulse. So impulse, correction, impulse, beautiful. Then you had a little bit of impulse, again, a little bit more liquidity here, price corrected a little bit and came back a little bit more aggressive, and then boom, continuation to the upside. So again, we're going to talk about combining all those things. So let's say you have bullish order flow. Here we saw a bullish order flow. You have a structure that's putting new higher highs in the market. You have structure, it's putting new higher highs in the market. Then you have, you have, a trend, you have momentum, you have impulsive break of structure, you have a continuation, you have imbalance, you have all those things. And then you have a little bit of more aggressive pullback. You can still take the trade. It's still going to be a little high probability because, you have all those good confluences and then you have a bad one. Or for example, you have a big wick. So you have impulsive breakout, but at the end, you do not have strong close. You have a wick. If price comes back correctively to the order block, that wick is respected and you can still take the trade and it's still going to be considered as a high probability. You understand? So this is, a little bit aggressive, a little bit not clean example of corrective pullback. But this type of setups, I love them. For example, I'm going to give you another tip about the pair characteristics. Whatever, never mind. I love this type of setups on GBP, okay, on GBP pairs. GBP pairs, especially GBP USD, for example, really good. So when you have one retrace and second retrace, 1, 2, so 1, 2 or 1, 2, 3, those kind of setups on GBP pairs are beautiful. So I would rather execute my trades on this type of setup than this descending, longer descending. Because again, guys, certain things work on some pairs and certain things work on another pair. So, you need to test them out. You need to test out things and see what is working on pairs, what is not working on some pairs, etc., etc. So for me, I would love to see this pattern form on GBP pairs. It is actually more high probability than seeing something like this. But again, this was pretty good. Not that impulsive, because you didn't had just momentum coming back, volatility coming back. So it was not considered, as aggressive, because you had an impulse downside, then you have a retrace, and then you have a second impulse. And then, this we can consider a little bit more aggressive, but still, again, on GBP pairs, I would rather execute this than something else as a pullback, if you're looking at only a pullback. Again, beautiful example, impulse, correction, impulse, okay? Again, we are summing everything up, so in your head, what are you looking for? What kind of price action you want to see in order to get involved in a trade, okay? So first, we had a weakness to downside, impulse to the upside, reaction, higher highs in the market. We are having this multiple reactions, bullish or flow, higher highs in the market, trend is present, momentum, look at this beautiful momentum, imbalance, strong candle close, impulse correction, impulse pattern, a little bit of liquidity here as well, a little bit of liquidity as well to the upsides, not as much, but again, so all of these things combined, and then really, really high probability setup here if this was a GBP pair, okay? So on certain pairs, if this was maybe, for example, I don't know, AUD USD, this would not be that high probability. For example, if this was on GBP USD, it would be, but again, it's still high probability because you have a lot of other confluences. So when you're trading, I'm going to give you a small tip as well. So when you're trading and you see it, you're marking up the charts and you're forecasting and, you're seeing whether you want to get involved in a trade or not. Good exercise that it's very good for you is to write down all those things. So on the left side, for example, you're gonna write down the positive things, and on the right side you're gonna write down the negative things. So you're gonna, let's say, for example, write down, first I have a trend, second, positive confluences, I have a trend going on, second I have momentum, third I have impulsive break of structure, fourth I have bullish or flow, sixth, 5, I have imbalanced liquidity. 6, you have all those good confluences, and then on the other side you have, I don't know, weak candle close and aggressive pullback, and then you're basically making your decision. So on the one side you have 5 good confluences, and then on the right side you have 2 bad ones. It's a little bit of, it's not high probability trade, So, but you have a lot of good confluences and you have a little bit of less negative ones. So let's say you could take a trade. Let's say you have 5 good confluences and you have 3 bad ones. Well, this is not in your favor. I would rather, skip that trade, because you have 3 negative confluences in compared to 5 positive ones. So it's a little bit, it's a little bit trickier. Let's say you have 5 good confluences and 1 bad one. You do not have to think twice about the trade. Of course, you're going to take it. You have a lot of good confluences and just 1 bad. So you combine those things, and this is also going to help you with your emotions, because you're always going to, as traders, when we're looking at the chart, we tend to have fear of missing out. We tend to see certain things and we have this feeling that we're going to miss on the move and that we want to get involved in that move. Certainly happen to each and every one of you. So what we tend to do is we analyze the chart and we actually analyze it wrong. It happened to me so many times. So I'm working with the students, guys. I know this type of things. So I'm talking to my student, for example, and he took a trade, okay? And then he's going to start breaking down the trade before he took the entry. and he's gonna start to break down the trade, as he's gonna magically see only good things about the trade, because those emotions are playing with him, because he wants to get involved in a trade. And then once he gets stopped out to trade and we do a session together and I show him that you had this negative confluence, this negative confluence, this negative, then he's like, oh yes, I missed that. And why have you missed that? Because you were thinking about getting involved in trades and not thinking about logically about the trade and everything that you see. So sometimes we tend to forget those negative confluences because we want to get involved in a trade. And this is why you should not trade with emotion, you should trade with logic. And it's a good exercise, writing down all those things and actually being, logical about the charts. So you're going to write down the positive things, you're going to write down the negative things, and then you're going to make your decision whether you want to take the trade or not. So we have an example, guys, here of aggressive pullback. Again, please stop and read all of those things because I'm not going to read them in this video. So I'm just going to talk about everything. Again, go ahead and read everything. It's going to help you tremendously. I have explained everything in those examples, guys. Again, we see that we have impulse, correction, impulse, again, high probability break structure, but we have imbalance left behind. We have momentum in the market. We have everything in this continuation here. But what happened here is that we had a quite nice big wick. Big wick usually indicates two things: either the correction, bigger correction, or volatility. Okay, so if you have an order block here and you have volatility, price coming back aggressively against you with momentum, that's a bad order block. But on other case, if you have a correction and price comes back correctively to your order block, generating liquidity, this is considered that wick is respected and we can continue to the upside. So there's difference between wick and aggressive pullback and corrective pullback. You should know that. Okay, so again, guys, pause the video if you want and just go through all of this that I have written here and just study everything. And again, once you study it, go ahead and apply it in your charts. So again, guys, example of a clear trend here, a pullback continuation pattern, but we have big wick left behind and aggressive pullback, and this means that this is low probability order block. This is bad to trade. So I see that a lot of people are looking at a lot of confluences and they're ignoring the pullback. There are actually a lot of traders, when I'm seeing charts, especially on Instagram, and when I see what traders are executing, oh my God, man. Oh my God. I sometimes I wonder, what are they doing? How they even trade, bro? But it's really astonishing for me. I do not understand when I see that traders, they have all those good confluences. Let's say they have structure, as they have imbalanced liquidity, bullish order flow, they have higher probability order block, blah blah blah. They have everything, but the pullback is aggressive, going against momentum, and they catch those kind of trades. It's never a good idea, guys. I told you. Going against momentum is almost never a good idea. So pullback is actually quite really important. Do not ignore the pullback. If you have a corrective pullback, your trades are going to be more higher probability, because corrective pullback indicates weakness to the downside and it's generating liquidity to the upside. So your trades are automatically going to be more high probability than you executing on volatility right here and on aggression going against momentum. It's almost never a good idea, especially if you have a tight stop loss. So again, example of low probability order block. We had all good confluences, but again, low probability order block, guys, here because we had a big wick and quite aggressive pullback. And here we have high probability break structure. Okay, so again, pause, guys, read everything. We have impulse, correction, impulse, a really high probability boss, really high probability order block right here with all confluences we actually want to see when we want to execute a high probability order block. And again, this is a chart example of that. Okay, so again, you have momentum, you have break structure, you have strong candle close, everything. So yeah, go ahead and study everything, guys. Read it. Here we have low probability order block. Low probability break structure. So why is this considered as a low probability? Is because you do not have momentum when you broke the high. So how do we break the high here? impulsively, right? We're breaking highs impulsively and we have momentum in this market. So this is why this is considered as a high probability order block or high probability breakout structure. And this is low probability breakout structure. Why? Because we do not have momentum in this market. Price has broken this with a wick. Basically broke with the candle body, but left a big wick behind. And this is why this is considered as really low probability. So let's say in this example, we had aggressive pullback. It would not be high probability, but still, if you had all of those confluences basically combined, you have high probability bust, you have strong momentum, you have imbalance, you have strong close, and then you have a corrective, you have impulsive pullback. So, you know, you have again 4 things, and maybe you combine a couple of more with the trend or whatever, you know, extra confluences, and then you have 5, 6, let's say 5, 6 good confluences and aggressive pullback. Maybe you can still take the trades, you know, because you have like 7 good confluences, only bad one, you know. No trade is gonna be perfect all the time, you know. Do not look at every single detail like I want to see everything, you know, in a trade. You're almost never gonna catch a trade that way, you know. Every trade is gonna have a little bit of negative confluences, but I'm telling you, you know, if you see this kind of price action when it's beautiful, high probability boss, strong client close, imbalance left behind, impulse correction, impulse pattern, you know, you could still execute an aggressive pullback. Corrective, that's high probability trade, but aggressive, you can still take it, you know, if you want to be, you know, a little bit more aggressive, but you know, you can still be a little bit more aggressive because on the other side you have a lot of good confluences. And here, if you see aggressive pullback, I mean, it's a bad thing. It's a bad thing. You don't want to execute here because price is showing a weakness. It doesn't have momentum. It's not showing you momentum to the upside, you know. Even the corrective pullback is not good idea here, but again, you can execute it if you have a corrective pullback, because what corrective pullback means is this week is being respected. I would prefer, for example, in this case, if this was a bullish candle, you know, and we had something like this momentum, and then with next candle we left a wick, and then we had a corrective pullback, that would actually be good. And in this example here, we didn't had a quite strong breakout and quite strong momentum. So with this week and corrective pullback, it would still not be a good idea. But again, guys, pause everything and read everything that I have wrote here, because I explained everything in smallest detail. It's gonna help you a lot. Okay, guys, and we have again chart example of a low probability breakout structure, guys. You see a low probability breakout structure, guys. Here we don't have momentum, we didn't break quite impulsively, we have a big ass wick left behind. I mean, this chart, this example is really bad. And right here, guys, we have inducement as an extra confluence. So this is basically, you know, something that is really quite beautiful. Okay, again, another perfect example on how your trades should look like. So I showcased the high probability example of confirmation entry, you know, a little bit in the beginning of the video, and I told you that this is the perfect example that you want to see. This is another perfect example that you want to see, and it's basically quite same, you know, it's continuation, high probability continuation, but with extra confluence of inducement, you know. So basically what you want to see is impulse, correction, impulse, quite nice continuation pattern, and then price coming back to this order block correctively with weakness, breaking the lows, retracing multiple times, showing you this descending price action, because descending price action is showing us weakness to downside and also generating liquidity on the way down. And also you want to see inducement as in form of double bottom here. It is more high probability because price is going to sweep that liquidity right here and then continue in the right direction. So another great example of high probability pattern that, again, guys, you can test out for yourself and see how high probability it is. So it's gonna make your charts really better and your trades really more successful if you trade this type of setups. Okay, so again, look at this. You have good boss, momentum, imbalance behind, strong candle close, corrective pullback, inducement. perfect. Again, go ahead and read everything, study it and apply it on charts. We have a chart example here, guys. Impulse correction, impulse, again corrective pullback, price reacting, going to the upside, again impulse, a little bit of price general liquidity here, corrective pullback, a little bit almost got stopped out because of it was. So we had one retrace, we had second retrace, we had third retrace, we have fourth retrace, I think this was, and we have 5 retraces. So you cannot say that this was aggressive because we have multiple retraces in momentum, but the bearish momentum was a little bit more aggressive. Again, you do not see momentum as here. There is no momentum, bullish momentum here, bullish, look at this, bullish momentum, bullish momentum, bullish momentum, bullish momentum, bullish momentum, bullish momentum. It's not like this. You didn't have that momentum, but it was still kind of bearish, You see that we have only, a couple of bullish candles and majority of them were bearish. So, yeah. Again, really high probability to use inducement as extra confluence, guys, on your charts. And this is basically it. Okay, high probability inducement example on the chart. Again, pause the video, read everything, study the charts in details. You have impulse, breaker structure, impulse, momentum in this leg. Then you have liquidity right here. Okay, you have liquidity right here, and then you have momentum, another momentum to the downside, another piece of momentum to the downside. Then you have supply zone here. A lot of traders would execute here, and again, you're looking what happens. I told you, sorry guys, I told you in the previous lesson that sometimes you can execute from here. Okay, even when you have imbalanced liquidity here. But what you want to see, the price is breaking impulsively, that you have momentum in the market, that price is showing you that it doesn't care about feeling that imbalance, feeling that liquidity. Sometimes you can execute from here, sometimes you can execute from here. In this example here, guys, we see that we have imbalance left behind, we have liquidity left behind, and we see high probability example of what price action loves to do. It loves to show us this basically trap, a fake out, tends to stop out these traders who are selling here, comes back, gives us a trap, usually on this momentum here. On this momentum here, people are looking at this as also a supply to demand flip. Actually, they're also breakout traders where they're gonna trade breakout. They're gonna break. Sorry guys, the traders who are trading breakout and retest are actually gonna execute here also as well. Traders who are trading from this demand are also gonna execute as well. They take a stop loss here. So a lot of manipulation happening, and basically it was only price just filling that imbalance, filling that liquidity, and following the structure. Continuing with the structure. Again, there are rules, again, guys, that you need to follow when you're, trading from momentum zone, and when you're gonna look at this as an inducement trade better. So it's really hard to explain, and it's hard to give you a lot of information but not reveal a lot of things about hybrid strategy. It's really hard. So I would really recommend joining the community and learning about those things, when it's the better time to take advantage of the momentum and ignore the imbalance, ignore liquidity, and when it's better to just wait for that liquidity inducement to happen and then trade. Charts are everything basically. So the examples, there are different kinds of examples on the charts, and again, if you go through this course, watch every video, you're gonna gain knowledge about it for sure. But you're gonna need a little bit of work and a little bit of time. Again, guys, if you're a community, okay, and if you're watching this video, you are gonna be having access to the community. We're gonna also send our charts. You're also gonna ask questions. So if anything is not clear to you, or let's say, for example, after you have watched the video, as I am telling you, go ahead, study everything, go ahead and backtest it. Send us your charts. Send us your charts. We're gonna review it and we're gonna give you a feedback. Okay, and we're gonna tell you those things. Again, I cannot reveal a lot of things, but again, after you have done with everything, go ahead and backtest it. And if something is not clear to you, ask us. Okay, DM me privately or just send charts into community, and someone is gonna review it and give you a feedback. So you're gonna learn the best way. That's the best way to learn. Okay, so here's an example, guys, of inducement. We have ascending price action here, indicating weakness, and again, massive momentum to the downside. We broke the structure. We had impulse correction, impulse. We had big wick and a little bit of corrective, and a little bit of corrective, a little bit of aggressive pullback. It was more corrective than aggressive. This bit of price action was aggressive. Okay, this bit of price action. Okay, so a small hint right here. Okay, this is the one. This is why I'm telling you. Basically, depends on the charts, and everything. So at this point, we had a wick. If you want to look at this to short from here. So this was an impulse, this was a correction, this was an impulse. Looking good, yeah? And then we have left the big wick behind. Then we have this quite aggressive move to the upside. Almost making a liquidity, almost, okay? But didn't. We had a one retrace, but this is considered as impulse, correction, impulse. Then we had a touched, you see that we are touching in this order block. Basically, this is impulse, correction, impulse, and we are touching this. We have a lot of liquidity imbalance here, so of course we're going to feel that. And we have imbalance and liquidity here, so of course we're going to feel that. So price action, breaking above, retracing, breaking above with momentum, coming back, touching this, and then continue to the upside. Again, coming back, touching this, continue to the upside. So at this point, price was, you can say, a little bit bullish, but also at the same time pretty corrective, generating liquidity to the downside. So you would be interested in trading from here. And then price action does this. This is where is your indication that you do not want to get involved in this. Why? Because this is going against momentum. Momentum is bullish. So your trades are not going to be high probability if you see a momentum breaking to the upside. Okay? And then you see it clearly. This was a trap. Basically, this was a fake out. There were a lot of traders who are going to start executing here on a breakout, a retest, on a demand zone. They're waiting for a demand zone. They look at this and they see demand. They see this supply getting taken. They see impulse, correction, impulse, and they want to get involved here. But actually, the right thing to do is short, because price action is still bearish. It's indicating weakness to the upside, momentum to the downside, impulse, correction, more impulse, and then again generating liquidity on the way up. It was just an inducement, a trap. Then price action is going to continue to make a new lower lows in the market and follow that bearish structure. So there are things in charts, that you need a lot of examples. You need a lot of, price action to go through to figure out when is the best time to get involved here, when is the best time to get involved here. Again, guys, in hybrid strategy, we have exact rules that we're going to follow. So we do not basically think about those things. When are we going to get involved? Where are we going to get involved? We do not think about those things because strategy is doing that for us. So, yeah. And this is premium discount, and we're going to touch this topic in the next lesson, guys. So yeah, hope you enjoyed the video, guys. Hope you learned something new. Again, quick reminder, if something is not clear to you from the course, from the videos, from examples, okay, just send us a message and we're going to be more than happy to reply and help you out. So yeah, that's basically it for this video, guys. I'm going to see you in the next one.